Good morning. This presentation reports the Part B economic analysis for the irrigation system decision in the energy economics assignment. The analysis compared three alternatives: a solar power irrigation system purchased by the company, a solar power irrigation system under lease, and the diesel powered irrigation system. The purpose is to identify the most economical alternative for the new irrigation system and to decide whether the existing diesel-powered irrigation system should be replaced by the solar option. Okay, this irrigation system is planned for paddy and maize fields covering 5 hectares in a remote area. This SPIS option is a 20 kilowatt peak stand-alone system, including PV panels, pumps, inverters, battery panels, boxes, storage tanks, pipes, and ground mounting. The DPIS option is a diesel-powered drip irrigation system. The analysis period is 15 years for all alternatives. The company's MARR is 10% and the corporate income tax rate is 25%. Since all alternatives deliver the same irrigation output, the decision is based on cost minimization. These slides summarize the main cost assumptions. The SPIS purchase option requires a purchase and installation cost of $39600 and has a salvage value of $34,137 and year 15. The SPIS leave option requires a refundable deposit of $2499 and an annual lease cost of $6,228. The DPIS option has an initial cost of $28900 and a salvage value of $12510. Insurance is paid annually for all alternatives. SPIS purchase has free O&M for the first 3 years, followed by $2277 per year, while DPIS has annual O&M of $3088. Inflation is ignored and all deductible business costs are considered in the after-tax analysis. The before-tax cash flow is calculated by subtracting capital cost, O&M cost, miscellaneous cost, and insurance cost. And then additing any salvage value present worth is then calculated by discounting each cash flow to year 0 using the 10% MARR. Since these are cost alternatives, the alternative with the lowest present worth cost is preferred for rate of return analysis. In individual, IRR is not meaningful because there is no exploitation revenue. Therefore, incremental ROR is used. The Extra investment is accept only if the incremental ROR is greater than or equal to the 10% MARR. For after-tax analysis, straight-line depreciation and the tax saving from deductible uh, expenses are included. This table shows the before-tax cash flow series for the three alternatives for SPIS purchase. Year 0 included the purchase and the installation cost, while year 15 includes the salvage value for SPIS lease. The cash flow include annual lease payments, insurance, and miscellaneous cost. And the year 15 lease cash flow reflects the deposits refund for DPIS. The annual cash flows include O&M, insurance, and miscellaneous costs. And the year 15 includes the salvage value. These cash flows are used for the before-tax present worth and incremental ROR calculations. The before-tax present worth result shows that SPIS purchase has the lowest present worth cost, equal to 76733.3 DPIS has a present worth cost of $80870.16, while SPIS lease has the highest before tax present worth cost of $82920.37. Therefore, using the present worth method before tax, SPIS purchase is the preferred option. This result is mainly due to its high year 15 salvage value and the relatively lower long-term cost. The before-tax incremental ROR analysis confirms the present worth result. The alternatives are ranked by initial investment and SPIS lease, DPIS and SPIS purchase. The incremental ROR of DPIS over SPIS lease is 11.21%, which is higher than the 10% MARR. So DPIS is accepted over this and this step. Next, the incremental ROR of SPIS purchase over DPIS is 15.3%, which is also higher than MARR. Therefore, the incremental ROR methods also recommend this SPIS purchase before tax. Okay, the after-tax analysis include straight-line depreciation and the tax effects. For SPIS purchase, annual depreciation is $364.2 because the depreciable amount is only $5463 calculated as 39200 minus 34137. For DPIS, annual depreciation is $1092.67. SPIS list does not claim depreciation because the company does not own the assets. However, the annual lease payments, insurance, and miscellaneous expenses are deductible this creates tax saving, which significantly affect and the after-tax compression. Okay, this table presents the after-tax cash flow series. The annual after-tax costs are lower in magnitude than the before-tax cost because deductible expenses and depreciation reduce tax payments. SPIS purchase and DPIS include the terminal salvage value and year 15, while the lease alternative includes the effect of the refunded deposit. These after-tax cash flow are then discounted at the same 10% MARR to calculate after-tax present worth. Okay, the after-tax present worth results show a different preferred alternative. SPIS list now has the lowest after-tax present worth cost equal to 6,265.47. SPIS purchase has an after-tax present worth cost of 6,471.41, and the DPIS has $6,507.2. Therefore, after considering taxes, the present worth method recommends SPIS lease. The main reason is that lease payments are deductible expenses are create a recurring tax shield. After-tax incremental ROI analysis also supported SPIS lease. The incremental ROI of DPIS over IPIS lease is 8.57%, which is below the 10% MARR, so DPIS is rejected. The incremental ROR of SPIS purchase over SPIS lease is 9.2%, also below the MARR, so SPIS plus is rejected. Although the incremental ROR between SPIS purchase and DPIS is 10.4%, it's not the controlling comparison because DPIS has already been rejected against SPIS lease. Therefore, the after-tax ROR method recommends SPIS lease. Before tax and after tax analyze lead to different recommendations. Before tax, both the present worth and incremental ROR recommend SPIS purchase. After tax, both methods recommend SPIS lease. The before tax result is useful for preliminary engineering comparison, but the after-tax result is more relevant because the irrigation system is used for business purpose and taxes apply. Therefore, the final selection should be based on the after-tax analysis. The recommended alternative for the new irrigation system is SPIS lease. The second task is the replacement analysis. Here, the existing DPIS is treated as the defender and the IPIS is treated as the challenger. The company has already operated the existing DPIs for 5 years. Therefore, the next relevant marginal cost of keeping the defender is the year 6 DPIs marginal cost, which is $7,502. The objective is to determine whether the company should keep operating DPIs or replace it with SPIs immediately. The economic life of SPIs Challenger is evaluated using equivalent uniform annual cost based on the given marginal cost. The minimum EUAC is 417.41 per year, occurring at the service life of 3 years. This means the best economic replacement cycle for the SPIS Challenger based on the given marginal cost data. These 3 years, this value is then compared with the next marginal cost of keeping the existing DPIs. The next marginal cost of the DPIs Defender is $7,502, while the minimum EUAC of the SPIS Challenger is only $4178.41 per year, since the Defender's next marginal cost is higher than the Challenger's minimum EUAC. Keeping the existing DPIs for other year is not economical. The present worst daily check also confirmed this. Replacing now gives the lowest present worst cost over the next 10 years. Waiting 1 or more additional years increases the total cost. Therefore, the DPIs should be replaced immediately at the end of year 5 or the beginning of year 6. The final recommendation are as follows. Before tax, SPIS purchase is preferred. After tax, IPIS lease is preferred. And because this is business investment and after tax result is more decision relevant. Therefore, the company should select a SPIS lease for the new irrigation system. For the existing DPIs, the company should replace it immediately with SPIS. This decision reduces the economic cost and supports the company's environmental and net zero objectives. So in conclusion, the Part B analysis has been completed for both the selection problem and the replacement problem. The before tax analysis favors SPIS purchase, but the after tax analysis favors SPIS lease, since taxes applied to the company. SPIS lease is the most appropriate final recommendation. The replacement analysis also supports immediate replacement of existing DPIS with SPIS. Therefore, the recommended action is to adopt SPIS lease and replace the existing DPIS now. Okay, thank you.